Welcome, everyone, to this exciting session that we've been literally working on for more than 6 months as a team. And I'll talk a little bit more about that. So the question is, why are we here? Why are we here? Well, what we know is that many hundreds of entrepreneurs are stuck in what we call the valley of death. This is the desert where, for many reasons, the $1.6 trillion of assets under management in impact investing is not reaching the entrepreneurs who actually need it, especially what we call impact-first entrepreneurs. You know, I can't move with this because it's okay. It's all right. I will constrain myself. Okay, so so what we decided to do here is to kind of double-click or focus in on one of the issues that we have noticed, which is this problem of the instruments and fund structures not being fit for purpose. What's available on the market under current market logic is not available. So how did we do it? Well, it is available, but it's not accessible. It's not fit for purpose for many of the entrepreneurs that we work with. So what have we done? We are a group of 8 self-described impact-first investors who basically have come together in a really unique way to gather data about what we call the true cost of impact-first investing. So not only do we hope that this research will help to illuminate and understand at a deeper level why do we see this valley of death, but also to motivate the use of more and more creative philanthropic capital, catalytic capital, in order to address this mismatch. So I'm going to get a little bit more into that right now. And we have 3 of our partners here who will reflect on their experiences after this brief presentation. So this is the launch of this research, the first time anyone has seen it. So let's see what you think. So first of all, if you think about kind of throughput, the number of deals, what we did is we compared our group with a data set, a combined data set of commercial funds, mainstream funds under 100 million, okay? And what we see is that we are doing pretty well. So our funds are more or less on average about 10 deals per year in terms of kind of basic productivity, which compares actually pretty well with the kind of mainstream finance. And as you can see, the debt funds on average are doing many more, and the equity funds a few less because there's a lot more kind of engaged work that needs to be done with these equity deals. So if you're thinking, oh, we must be less productive, and that's one of the problems. That's one of the reasons why, you know, we're having this mismatch. Well, that's actually not the case. So then we started to look at, okay, what about the cost per deal? Maybe it just costs, you know, too much for us to do any individual deal. And what we also then found is that the average cost is about $80,000 in the impact space. But guess what? It's about $120,000 in the commercial space. And what's also interesting here, you might think, okay, well maybe if you're doing bigger ticket sizes among the impact first people, that maybe that's gonna have an impact on the cost per deal. But it doesn't. There's no correlation whatsoever. It's basically around $80,000 per deal, regardless of size. So, we're kind of, you know, cost efficient. Then we asked ourselves a question, and this is where it bites, cost per dollar. If you look at cost per dollar, this is where we are much more expensive at about, I think the average is, hold on a second. Yeah, 21 cents, that's right. Average is 21 cents on the dollar, whereas the mainstreams are more like 8 cents or 6 cents between 6 and 8 cents. So this is where, in fact, you could look at it. The logic could be, ooh, yeah, that's very expensive. And you can see that in this case, there is a correlation in terms of the ticket size. So the larger the ticket size, the lower the cost per dollar. And we know this, right, on some level, right? We know this. But this is the data that we have that shows this. However, unlike the mainstream funds, if we think about this cost as just like a bunch of overhead, then I think we're missing the boat. Because when you look at what we see in the transactions, that's the tip of the iceberg, literally. And there's so much value that we are adding to help create the impact that we all want to see. Essentially, what we're seeing is the cost of creating impact. And who's going to cover that cost, right? There's a lot going on that we do to ensure that the companies, fit to our impact thesis, but then also deliver, are in the best place to deliver on that impact. So we would like to suggest that we sort of reframe our thinking. So instead of being sort of, apologetic, comparing ourselves to commercial rate returns, we have longer tenors or lower returns and all this other, the concessionary kind of conversation, is to reflect on what are we conceding with commercial rate returns, and we should be thinking about comparing ourselves to the philanthropic funding and looking at how this is an amazing opportunity for philanthropic catalytic capital to invest in social entrepreneurs and invest in impact-first investing. Here you have the kind of the basics. It's, instead of being a one-time outflow for a typical grant project, you have impact that continues over time. Instead of just funding, inputs and outputs, you actually are de-risking social entrepreneurs and whole sectors and systems that are creating that impact. And then finally, this is the kind of impact that you can have that will grow and have, like I said, more of a systemic impact. So we did some case studies. These are all companies that many of us in our group have funded at one point or another. And we talked to the founders of these organizations to say, what do you estimate is the role of catalytic capital in your growth path? And all of them said, we asked them to kind of estimate against a counterfactual. What would have happened if you didn't get it? And what do you think the impact is? And they're all several multiples of impact. Down across the bottom there, these are the estimates that Jibu, which is a water franchising company across a number of countries in Africa, Clínicas Azúcar is a healthcare program for diabetes in Mexico, and Husk Power Systems and mini grids across India and West Africa. 3 completely different sectors. Many of us have supported all of these. And the idea here is they themselves are saying that they are achieved between 7 and 47x on their impact because of somebody or some group of people being willing to support them with catalytic capital at some point in their career, which is, I think they are the most important voices in a way in the room to say this is what made the difference. A couple of the cases they said we might not be around still if it hadn't been for some of those early believers, right? Great, so that's pretty much all I had to say. Now I'd like to invite my panelists. You want to start us off, Dan, and just talk about your reflections on this study and how it relates to your work at Acumen.
I'd be thrilled to. I think first a quick round of applause for Brigit, because this took a lot of work to put all this together.
Diana.
And the Miller Center team in general, this has been a really exciting opportunity for us. Yeah, this took me on a bit of a journey. I'm Dan Waldron. I'm Director of Insights at Acumen. We're an impact-first investor and have been for a long time. Because do I think our costs could be lower? Yeah. Do I know that there's inefficiency? Sure. And do I think the push to to reinvent investment and be more innovative in structuring instrumentation makes us less inefficient? I have these thoughts. And then sitting with it more and talking with this kind of incredible group of people, do I want to be as efficient as capital that sort of forgets people and marginalizes community and externalizes its impact on ecologies and ecosystems? No, I don't. We cost more, and you get more for it. And we're an early stage equity investor. Finding deals and making deals is hard. We make it a very relatively small checks, $250,000, $500,000 initial check. We are funding counsel, we are funding teen time, we are funding counsel for the companies we're investing in some cases, right? We are meeting Tanzanian entrepreneurs with a tutoring platform and who have never seen a term sheet in their lives. And when we send it to them and they send it back and say, hey, looks great, that person needs a little bit more accompaniment. They need somebody to work with them, right? And they cannot fund that cost, we fund it. When we are investing in a cooperative in rural Colombia that is growing rice or cacao, that wants to form a JV that we're going to put equity into, the sentence I just said took a year to walk that community through what that meant and the implications of it. They couldn't bear those costs. And so we cost more, you get more for it. It requires a different funding structure for the investors, but it also requires a different model for how we invest. And so was really happy to hit reset, and I'm really happy to talk about what that funding structure could look like, because we and everyone on the stage, and frankly many in this room, are incredibly efficient engines for creating impact out of dollars.
Hi everyone, I am Caroline Bressan with Open Road, and I want to take you on a little bit of a personal journey for a moment. How many of you have MBAs in the room? Okay. So I went and got my MBA after working for an impact fund called Calvert, who many of you know, and I didn't raise my hand for the first semester that I was in a finance course because I didn't think I had real financial experience. I had done dozens of debt deals at Calvert over the 5 years that I was there, but there was something about this mainstream finance that made me think that other people knew better than me, when in fact I had more transaction experience than most of the people in the room. And so that's what getting this group together is really about. It's about proving that impact-first investing is just as rigorous as anyone on Wall Street, but what we're doing is significantly harder to also get that deep impact. Open Road was founded to fill a gap. We do bridge financing. 80% of the time, our loans are going to cover operating costs, keeping the lights on while organizations are waiting for longer-term funding. As a recent example, we're providing a loan to a nonprofit health organization that's paying frontline workers in Ukraine. They were one of the few organizations that's still going to be getting a grant from the US government, but in the transition between USAID to State Department, those checks aren't coming on time. And so what happens? Do you go to a bank? No. Open Road provided a $350K loan so that they can literally pay their workers while they wait for that check to come in from the State Department. The other thing I want to note is all three of us up here are nonprofits. And so we literally have impact embedded in our mission. I do believe there's a trade-off between impact and return, and I think that we collectively have to state it and be proud of it and say this is how philanthropic capital is being used to preserve that impact. So thank you to Brigit and her team. This is just the beginning. Hopefully we'll get more collaborators along the way contributing to the data set to really build our case and make it more strong.
Wonderful. Thank you so much, Brigit and Miller team. You guys were, we like to say, herding cats over the past 6 months, and it was a very pleasant experience to be a cat alongside these folks. And part of that is that it was bringing together an ecosystem of folks that have been doing this for a long time. Global partnerships. We're an impact-first fund manager. We've been managing funds for 20 years, predominantly debt funds. And so I was largely the one in the room saying, it's not a single valley of death. We have half the global population living on dollars a day without access to basic goods and services. If that's not the definition of a sustained market failure, I'm not sure what is. And so as an impact investing community, we're coming to terms with the reality that the incentives within traditional markets are not incentivized to serve the global majority that still needs access to livelihood creation, health, energy, water, food. These are basic needs. It's also a large addressable market for those of us who see the market opportunity, see the fact that there is resilience to be invested in. We've managed 11 funds, 6 of those have successfully matured. We're investing largely in growth stage social enterprises that are addressing the basic needs of people living on dollars a day. What I would name is that when we talk about there isn't a single valley, is that we watch organizations, and we've all invested in them from seed, right, as the catalytic capital in the room is saying seed, but what about scale, what about sustain? So if you're focused on global poverty, which is important to step back first and say, what is the impact I'm looking to enable and for whom? We see global poverty as a sustained market failure, and there are social enterprises that are innovating. They need early stage capital, deep hand-holding from the providers. Up on the stage, they're doing that, and we communicate. You know, Caroline's group steps in when the oh shit moment happens. You can beat me out, SOCAP. But they happen, right? It's not a linear path from early stage to growth and scale. And an example, you know, we invest, for example, with BRAC International Holding, which has affiliates in Sierra Leone and Liberia. They're serving over 1 million low-income women living on dollars a day, largely making their livelihoods off of agriculture. They're on the front lines of climate change. It is a scaled model, and they need access to patient, low-cost working capital to continue to innovate on the edge of the market. And so for global partnerships, oftentimes our conversation with investors is around the fact that you can have scaled and sustained impact. Your capital can recycle through these models, and you can preserve your capital, but we're not going to sit here and tell you that you can have your cake and eat it too. You need to value the impact in economic terms, and that's where this is the best alternative to philanthropy in the market, because you don't have to compromise on future giving, and in this moment, we really do need capital recycling.
Awesome. Right. Okay, so this is pretty much the end of what we're going to talk about. And now it's going to be all up to you. I love that the cake and eat it too. I'm glad you guys mentioned it. How many people were here at SOCAP last year? Do you remember that gigantic blow-up cake that we brought last year? Yeah, we're kind of pushing the... And now we have the reset button. So we're just kind of, I think all this kind of guerrilla marketing is meant to kind of stick in your heads about like what are the main messages we want you to reflect on as we move forward. So what we're going to be doing here, can I grab the, is first and foremost, thank you very much for putting up your sticky notes. This is a methodology that we use so that the agenda for this meeting is coming from you, right? So the topics that we're going to discuss now and connect back to this true cost conversation are going to be, let's see, we have 8. We have 8 topics, and we'll probably have about 12 groups. That's how many moderators. Can I get the moderators to do something? Yeah, raise your hand. Oh, numbers. Do you each have numbers? Does everybody have a number? The moderator doesn't have a sign. Go see Jeff. Yeah, okay, well, you guys will get your numbers in a minute. Okay, so... here's what we're going to do. It's a little bit messy, but it'll work. Trust me. You just have to bring your chairs to different places. So here's the first, number 1. Who's our number 1? Okay, if you're number 1, go with John. Funder, inertia, lack of education, right over here in this corner. Funder, inertia, lack of education. Yeah. That's exactly where I'm headed there. Yeah, I'm definitely not asking you to move right now. That would be a disaster. Number 2, who's got number 2? Okay, Zaki. If you're number 2, right in the middle here, industry gatekeeping, lack of entrepreneur awareness. Ooh, that's a good one. Number 3, with Diana in the back corner over there, lack of fit-for-purpose instruments. Number 4, right there, okay, so maybe move a little bit over because, yeah, they'll be too squishy. Capital is stuck, funders not taking enough risk. Number 5, you know, DAFs, anyone? Okay, number 5, lack of inclusion and not reaching the right people is right there. Number 6, Risk return expectations don't support deep impact, right back there in the corner. Number 7, weak impact measurement and management and impact washing happening. Right over there with, over there. Okay, and then 8, not enough money investment in human capital, which will be right here. Okay, so I'm going to repeat one more time. And funder inertia, lack of education, number 1. Number 2, industry gatekeeping, lack of entrepreneur awareness. Number 3, lack of fit-for-purpose instruments. Number 4, capital is stuck. Funders not taking enough risk. Number 5, lack of inclusion and not reaching the right people. Number 6, risk return expectations don't support deep impact. Number 7, impact measurement and management, impact washing. Number 8, not enough investment in human capital.